Hello everyone, welcome to Insurance Business TV and the Q3 edition of our Cyber Insurance Power Panel. Yes, this is where we bring together some of the top insurance brokers from across the country to get the latest on the market and to offer their insights. And today we have a fantastic duo. Salom Domey, he is broking manager at Talbot Jones Limited, and Daniel Wynn, a broker at Capsule Insurance. So let's delve into the state of the market. And UK cyber insurance premiums for retailers have risen by as much as 10%, triggered, of course, by the high-impact ransomware and social engineering attacks on major chains, including M&S, Harrods, and the Co-op. So how should brokers counsel retail sector clients proactively on limit adequacy, sublimits for BI, and indeed premium budgeting, now that insurer underwriting scrutiny in retail has intensified? Salom, let's get your thoughts on this.
Yeah, so I think I'll probably touch on three main areas. So limit adequacy, looking at premium budgeting, and then policy terms. So in terms of limit adequacy, it probably offers the opportunity to look at benchmarking. And so with these sort of incidents that have happened, this offers the opportunity to explain to clients so they can reassess and reevaluate their policy limit in line with the exposures that these three organizations have suffered. And it's important to mention that M&S, Co-ops, and Harrods are probably not just the only organizations that have suffered. These are probably the big ones that have made the news. There will be other small organizations that have suffered significantly. So it's important for organizations to then have these open discussions with their brokers to understand what are exposure. So if you take, for example, M&S, you realize the online system, so click and collect orders, were offline for about 15 weeks. So it helps you to understand how long it's going to take to come back to business as usual after you've suffered these sort of incidents. You hear news about M&S suffered 3.8 million losses every day for this period of time. So it helps organizations to be able to assess in terms of the financial impact and then how long it's going to take to be able to reconfigure these systems so they are able to serve customers properly. And in terms of premium budgeting, like we've rightly said, about 10% increases. So organizations should be open about it, understand this, and factor that into their budgeting and forecasting, knowing that these are the reasons why these increase in premiums are occurring. And in terms of policy terms, this offers brokers and clients, again, the opportunity to have open discussions about policy exclusions, policy limitations, triggers, and probably think about doing like scenario testing to say, well, looking at our current policy, if this incident that has happened to M&S or Co-ops had happened to us, how is our policies going to respond? And then once you have those sort of discussions, brokers and their clients can have better understanding of where to make some changes and switches to make sure policies are responding as they would expect in the times of unforeseen eventualities.
That's a great opening statement. And Daniel, just to bring you in as well, I mean, I think really good point that Salom makes there. Perhaps the silver lining to the cloud is that we're now getting a little bit of perspective in terms of the realistic downtime for businesses, and perhaps that's something that brokers can pass on to their clients.
That's right, and I think it's our job as brokers to understand, the potential losses for our clients and to help them, guide them, and to find that number to be insured for. Obviously, M&S is a large retail store, but they don't hugely rely on their online retail outlet, or it's not their primary source of income. But we've also seen that the large impacts it's had as a result of that. They had £100 million worth of cover. Their estimated loss is going to be 300 million. So I think as brokers, we need to be looking at what the potential outcome could be for a client and for limits and looking at the sublimits within a policy. Obviously not all clients are as big as M&S. Some clients are, we're only buying up to £5 million worth of towers, but we need to look at the sublimits in there for business interruption, and if they are covered adequately for their clients. If there's enough cover that's going to be there for them, it could be the difference of a client staying in business or going out of business as a result of a cyber incident. So we need to be protecting our clients as much as possible, just as we would with property insurance, really. And I think from the premium point of view, I think we as brokers need to be making sure that our clients are getting as much value as possible for their money, making sure they've got the full sublimits that are required in there, any additional services that the clients may be able to use that are free of charge from insurers that they may be paying for elsewhere as well. So I think it's just us as brokers knowing the market, where's the best place to put it, not necessarily just on price, but for the cover and additional services as well that are provided by insurers.
Just to extend on the M&S attack, if I can, with you, Daniel. Of course, it was carried out via social engineering against a third-party contractor using SIM swapping and phishing to breach core systems. That, of course, highlights the ongoing vulnerability in some of these vendor relationships. So what policy wordings, perhaps notification clauses or due diligence endorsements can brokers include to ensure that those supply chain mediated exposures are covered and indeed underwritten appropriately?
That's right, but I think the supply chain is such a huge area of concern for insurers, especially because of the potential losses as a result of something that's not in our client's direct control. So putting sort of endorsements on policies, mandating minimum security standards for these third-party vendors to have is going to be very good to help insurers limit their losses, but also for clients to limit their losses as well. They can also require vendors to notify the insured of any incidents that they've had in-house within sort of 24 to 72 hours to help insurers be prepared and put their insurers on notice and sort of do any sort of background checks or due diligence checks in their own systems as well to prevent these sort of large losses from happening again.
I guess as well, Salome, it's just important to take something of a holistic view to the situation.
Yeah, definitely. I mean, what's the value of a client putting everything right in place and then having a vendor who sort of brings in some exposures and vulnerabilities? So like Daniel has rightly said, it's now important that you don't just look at your system, you have to now consider the systems of your third-party vendors and suppliers, asking the right questions. And then again, insured or policyholders should look at probably the contracts they have with their vendors and third-party suppliers, making sure that some of these requirements are written clearly in terms of maybe cyber security requirements, cyber policy requirements. Again, policyholders can engage openly with brokers who can engage with insurers to understand some of that debt value services that insurers are offering, and then be able to pass this on. So if you take, for example, the likes of, I think, Coalition and then CFC, they have a platform that allows policyholders to scan the IT interface of any third parties before onboarding. So policyholders probably might take approach like, let's say, in terms of onboarding, they do scannings in a renewal, like at very key points within the third-party vendor relationship management. There are scans that are done within the systems, and also getting advice from the relevant cybersecurity aspect would go a long way to help them protect their organizational assets.
And just to sort of flip the script a little bit, even though there were these high-profile losses in Q2, UK cyber insurance rates have actually dropped by about 7% in primary layers, with capacity, of course, still abundant. So that's created something of a dissonant market dynamic between weak pricing and rising losses. So, Salome, in this sort of buyer-friendly environment, I guess we can say, but also a risk-intense environment as well, how should brokers advocate for disciplined retention structures, layered limits, or privacy fines modules to manage those long tail claim inflation?
Yeah, definitely. So I think it's important to understand the exposures and then what the potential impact or cost would be to the organization. So instead of just looking at a standard retention on a policy, it would probably be better to look at it in terms of the various sub-limits, or look at the various triggers within the policy and understand where the most concern or the most potential impact is to the organization, and then be able to set retention limit accordingly. Again, what we've also noticed is, I think now most insurers are probably even offering any one claims basis compared to previously where it was just aggregate limit. And so clients should not just focus on pricing, they should probably look at the holistic cover that they are getting, and then make sure that what they are receiving responds when they need that. In terms of the entire policy, instead of just having one policy, probably they can look at like tower approach, where you have a primary policy and then excess layers. That also has very good impact in terms of mitigating the total cost on cyber premium spend.
Yeah, that idea of building tower structures is really important, Daniel.
That's right. Yeah, I think it helps insurers mitigate their losses as well. If we can just, if one insurer's got the 1 million rather than the full 10, we are seeing insurers generally putting out higher lines on cyber insurance, whether it's offering 5 million line or a 10 million line. But I think protecting the long-term growth of cyber, it doesn't take many claims to hit total limit losses for insurers to start seeing an impact on the entire book size. So I think from that point of view, it helps there. Like we were saying, on the retentions that are out there. Having a higher deductible is going to obviously bring the pricing down for clients. But I think we only need to really look at that on sort of the larger clients. I think for smaller clients, we need to be demonstrating that they've got the coverage there from the offset. £5,000, £10,000 retention for clients. That can have quite a large impact on the smaller SMEs. So there are insurers out there now that are offering that on a nil deductible basis. So I think it all depends on the client and how we're structuring programs and what's in their best interest, really. While the rates are reducing, I think we are able to review the cyber market for clients, making sure they've got the adequate coverage there. Like we mentioned in earlier parts, the sublimits is a big part, and that's where some insurers will reduce coverages massively in these areas. Some will give full policy limits. So I think it's understanding between the two policies where the clear differences are, for clients to get the most value for their money and to protect them long term as well.
I just want to change pace with you if I can. A recent WTW report suggested that cyber attacks, data loss rank among the top risk concerns for UK directors and officers, of course, putting pressure on boards to oversee ransomware preparedness, disclosure and recovery plans. So how can brokers, Daniel, integrate those board tabletop exercises, perhaps those cyber risk advisory services and governance engagement into policy placement to sort of demonstrate that value beyond simply claims coverage?
That's right. And I think that's the big thing about cyber insurance. It's not just about the claim at the end of in a policy. Obviously, we always want the claims to be paid out, and that's a big part of the insurance policy. But there are a lot of added values for clients to have throughout the policy year. I think to have a broker sort of tabletop exercise, claim simulation, where we bring everyone together and everyone sort of can understand what they're getting out of insurance, who's doing what in the event of an incident. It really puts things into perspective a little bit more, knowing what to do at a time, I think. And it also helps to lower the cost of a claim. If everyone knows what they're doing straight away, everyone can get into their job rather than running around like headless chickens, really, of who's going to be doing what, who do we need to call, when do we need to get insurers involved, I think is always a big one. A lot of clients that I've spoken to, it's not necessarily their first step is to speak to an insurer, but insurers have the incident response teams there for a reason. Some of these companies have 200 plus professionals, and it's getting them involved at the earliest process can help prevent larger losses. And then again, on the advisory services, insurers can help create incident response plans, do ongoing sort of cyber training for clients, phishing simulations. All of these things can be free of charge, and and clients are generally paying for these outside of these services, outside of the insurance services as well.
And of course, this is, of course, assuming, Salom, that we're able to kind of create that curiosity at board level, the interest from them.
Yeah, definitely. I mean, it's probably high time that we stop looking at cyber risk as just an IT issue. It's probably something that should be moved up the rank to a board level discussion. So, I mean, most organizations would have board subcommittees, so it probably makes sense to have board cyber subcommittees to sort of look into some of these sort of things and not just have this left at management level or the IT level. So board could probably look to institute organizations like, let's say, outsource organizations to carry out cyber risk assessment within the organization, maybe annually or periodically, just to assess what is happening with within the organizations, what are the exposures. And then most of these research work or most of these consultancy work would probably come with recommendations and advice on what can be done, which can then be triggered down to the various sub-units or subcommittees within the entire organizations for effective monitoring of cyber risk, and then making sure that the exposures are not just known, but something is being done actively. With these sort of things, it encourages insurers and underwriters to understand that organizations are actively looking at cyber risk and then are doing everything within their means to make sure they protect this. So it's not just a business as usual risk, which sort of give underwriters some comfort in terms of making it sure that clients get better policy terms coverage and then pricing.
Just have one final question to throw at you both, and that is, of course, about the proposed Cybersecurity and Resilience Bill, which is now in parliamentary process. It will require potentially expanded incident reporting, mandatory compliance standards, broader oversight over critical infrastructure and managed service providers as well. So, Salom, how should cyber brokers prepare to adjust their policy forms, incident response enhancements, and indeed coverage limits now that this mandatory reporting is expanding under this new UK regulation?
Yeah, I think it probably starts with education. So having open discussions with policyholders or prospective clients, first to understand if they know about the changes that are happening, do they know the impact or what is contained within this new bill, and then what is expected of them, both in terms of the regulator's perspective and then in terms of the underwriters or insurance perspective. And so once these discussions are being we are having these discussions with clients, then we can be able to probably guide them better, see what is available from the insurers, see what's available from other third-party consultants, to make sure that clients are in full compliance with what is expected by them from these laws, and then what's expected by them from insurers, to make sure that at any point in time they are getting the best value for money in terms of their whole cyber program.
And Daniel, I guess it's just, again, necessary to kind of sit down with them and understand what procedures they have in place.
That's right. I think we need to sit with our clients, understand how their current compliance around data and incident reporting is in place at the moment. Does this need to be changed? Obviously, we can generally sit down with insurers as well. They can give their point of view and to help hold hand their clients. They're working with a number of clients all the time from different sizes, so that they understand what the best practices are, and especially when new sort of Parliament's process reviews come into place, there can be a lot of extra costs, and UK regulation will require things to be done in certain ways. So I think we need to look at the limits as well that clients will have when there is regulation in place. Like I say, things have to be done in a certain way, which takes more time and then costs more money for clients. Currently, notification costs can anywhere between $5 and $8 per individual to be notified. Is this going to increase as a result of the new regulation? Someone holding 100,000 data records, for example, that the value can increase very quickly as a result of that.
Great thoughts, and indeed another fantastic panel. Huge thanks to our cyber specialists. Remember, they will be back together one more time this year in Q4, so keep your eyes peeled for that. And we'll see you next time right here at Insurance Business TV.